You know what's interesting? Most people think owning precious metals keeps them under the radar. They believe stacking silver is the quiet way to preserve wealth while the system crumbles around them. But here's what nobody's telling you. Once you cross certain thresholds, you're not invisible anymore. You're on a list, and 500 ounces of silver, that's exactly where the line gets drawn. Let me explain what's really happening right now, because this goes way deeper than most people realize. Silver just hit over $53 per ounce, recently up 76% in a single year. That's not normal market movement. That's panic buying. That's institutions scrambling. And when you own 500 ounces at these prices, you're sitting on roughly $26,500 in physical metal. That puts you in a very specific category that governments, dealers, and even your neighbors are starting to pay attention to. But the target on your back isn't just about the dollar value. It's about what that amount of silver represents in the new financial system that's being built right now while everyone's distracted. Think about it this way. 500 ounces isn't a casual hobby anymore. It's not a few coins in a drawer. That's 31 pounds of pure silver. That's serious weight. That's serious wealth. And more importantly, that's the exact threshold where you transition from small retail buyer to significant holder in the eyes of the system. Here's where this gets really interesting. Every major dealer reports transactions to various agencies. They have to. It's the law. And while there's technically no federal requirement to report silver purchases under $10,000 in a single transaction, that's not the whole story. Dealers keep records. They track patterns. They know who's accumulating. And when you've made multiple purchases that add up to 500 ounces or more, you're in their database as a significant precious metals holder. But that's just the beginning of why you're a target. Let's talk about what's driving this massive silver surge right now, because understanding this will show you exactly why holding 500 ounces makes you valuable to the wrong people. The industrial demand for silver is absolutely exploding. Solar panels alone are consuming over 200 million ounces annually, and that number is projected to double within 3 years. Every electric vehicle uses up to 1 kilogram of silver. 5G infrastructure requires massive amounts. Medical applications are expanding. The industrial consumption is so intense that we're now mining less silver than we're using for the first time in decades. Above-ground silver inventories are being depleted at an alarming rate. The COMEX warehouses that back the paper silver market have seen eligible silver drop by over 60% in the past 2 years. That's physical metal leaving the system, and it's not coming back. Meanwhile, central banks around the world are quietly accumulating precious metals at the fastest pace since 1967. They're not buying silver directly in most cases, but they're buying gold hand over fist, which pushes investors into silver as the more affordable alternative. The gold to silver ratio has been compressing, meaning silver is catching up to gold's gains. When that ratio tightens, silver moves violently. But here's what makes your 500 ounces so significant. You're holding real, physical metal in a market that's 99% paper. For every ounce of physical silver that actually exists, there are estimated to be 100 to 250 paper claims on that same ounce through futures contracts, ETFs, and derivatives. You're one of the few people who actually owns the real thing, and that makes you a target in multiple ways. First, there's the obvious. Theft. As silver prices climb and economic conditions deteriorate, precious metals become the most liquid form of wealth outside the banking system. Home invasions targeting precious metals holders have increased significantly in the past 18 months. Dealers have been robbed, private holders have been targeted, and the common thread? The criminals knew exactly who had significant holdings. How did they know? Sometimes it's loose lips. Someone mentions their stack at a coin show or online forum. Sometimes it's delivery drivers who notice the weight and packaging of shipments. Sometimes it's employees at dealers who leak customer information. And sometimes it's just pattern recognition. If you're making regular purchases at local coin shops, people notice. But the physical security risk is actually the smallest concern. The bigger target on your back comes from the government's increasing interest in precious metals holders as we move towards central bank digital currencies and greater financial control. Let me paint you a picture of what's coming, because this is already happening in other countries, and the framework is being built here right now. When governments need revenue, they don't just raise taxes on income, they go after wealth. And precious metals represent untraceable, untaxable wealth that exists outside their control. That's a problem for them. A big problem. We've seen this movie before. In 1933, Executive Order 6102 forced Americans to surrender their gold to the government at $20.67 per ounce. Then, once the government had collected everyone's gold, they revalued it to $35 per ounce. Instant 69% profit for the Treasury, instant 41% loss for citizens who complied. Could they do that with silver? Absolutely. In fact, silver might be an even more attractive target because it's more widely held by middle-class Americans. Gold is for the wealthy. Silver is for regular people trying to protect themselves, and there are a lot more regular people than wealthy ones. But here's the thing. They probably won't confiscate it outright this time. That's too obvious. Too much resistance. Instead, they'll do something much more subtle and much more effective. They'll tax it into oblivion. Imagine a scenario where precious metals are reclassified for tax purposes. Right now, silver is taxed as a collectible with a 28% capital gains rate, which is already higher than stocks. But what if they implement a wealth tax on precious metals holdings? What if they require annual reporting of all precious metals over a certain threshold, say 500 ounces, with a 2% annual wealth tax on the current market value? Suddenly, your 500 ounces at $53 each, worth $2,650, costs you $530 per year just to own, every year, whether you sell or not. And if you don't report it, that's tax evasion. That's criminal. Or here's another scenario that's even more likely. They implement capital controls during the next financial crisis. They freeze bank accounts. They limit cash withdrawals. They restrict international transfers. But precious metals? Those can still move. Those can still be traded. Those become the underground economy. And that's exactly when they'll crack down hardest on holders. Because if you have 500 ounces of silver, you have the ability to operate outside their control. You can trade. You can barter. You can preserve wealth while everyone else is trapped in a failing digital system. That makes you dangerous to them. That makes you a target for enforcement. Now I know what some of you are thinking. I'll just keep it quiet. Nobody knows I have it. But that's where most people make a critical mistake. They think their silver holdings are private. They're not. Every purchase you made with a credit card? Tracked. Every purchase over $10,000? Reported. Every shipment to your address? Logged. Every online forum where you mentioned your stack? Archived. Every coin show where you paid with a check? Recorded. The data exists. It's just a matter of whether they decide to use it. And here's something most people don't realize. Dealers are required to file Form 8300 for cash transactions over $10,000. But they're also required to file if they suspect you're structuring transactions to avoid reporting. So if you bought $9,000 worth of silver 3 times in a month, that's suspicious. That gets reported. The IRS has been dramatically increasing its enforcement division. They're hiring thousands of new agents, and one of their specific targets is precious metals transactions that might indicate unreported income or wealth. But let's say you've been careful. Let's say you bought everything with cash from private sellers. No paper trail, no records. You're completely off the grid with your 500 ounces. You're still a target, just a different kind, because now you have to worry about the people around you. Family members who know you have silver, friends who've seen your stack, ex-spouses who might mention it in divorce proceedings, heirs who might report it to the IRS when you die to avoid estate tax complications. Precious metals are only as secret as the people who know about them. And 500 ounces is hard to keep completely secret because it's not a small amount. It takes up space. It has weight. It requires secure storage. And secure storage means either a safe in your home, which is obvious, or a safety deposit box at a bank, which creates a record. There's another angle here that most people miss, the social target. As economic conditions deteriorate and more people struggle financially, wealth inequality becomes a flashpoint, and visible wealth becomes a target for resentment and worse. If your neighbors know you have significant precious metals holdings while they're struggling to pay rent, you become a target for social unrest. We've seen this throughout history. When societies break down, those with portable wealth become targets. It doesn't matter if you earned it legitimately. It doesn't matter if you were just trying to protect your family. When people are desperate, they look for anyone who has something they don't. And 500 ounces of silver? That's enough to feed a family for a year in a crisis. That's enough to buy a car. That's enough to be worth the risk for someone who has nothing to lose. Now here's where this gets really important for anyone sitting on retirement accounts right now. If you're holding $100,000 or more in a 401k or IRA, you're watching the same economic indicators that are driving silver to record highs. You're seeing the same inflation, the same currency debasement, the same geopolitical instability, and you're probably wondering how to protect that wealth without triggering massive tax consequences. That's exactly why I put together a comprehensive guide on how gold IRAs actually work. It's completely free, and it's in the description below. It walks through the entire process of moving retirement funds into physical precious metals without penalties, without taxes, and most importantly, without creating the same target on your back that holding physical silver at home creates. Because when your metals are in an IRA, they're held by a qualified custodian in an approved depository. There's no safe in your house, no risk of home invasion, no social target, just legitimate, protected retirement wealth in physical form. If that's relevant to your situation, definitely check that out. But let's get back to the immediate issue. What do you do if you already own 500 ounces or more of physical silver? First, understand that the target on your back grows with the price. At $30 silver, 500 ounces was $15,000. Significant, but not life-changing. At $53, it's $26,500. But where's silver going? The technical analysis is showing a breakout pattern that hasn't been seen since the 1980s spike to $50. The fundamental supply-demand imbalance is worse now than it was then. The monetary conditions are more extreme. The geopolitical tensions are higher, and the industrial demand is exponentially greater. Conservative analysts are projecting $75 to $100 silver within the next 18 months. Aggressive analysts are calling for $150 to $200 if we see a real supply crisis or monetary collapse. And the extreme scenarios, the ones that account for a full paper market collapse and physical shortage, are projecting $500 to $1,000 silver. At $100 silver, your 500 ounces is worth $50,000. At $200, it's $100,000. At $500, it's $250,000. The target on your back grows proportionally. So what's the solution? How do you protect yourself while still maintaining your position in what could be the trade of the decade? This is where most people make another critical mistake. They either sell too early and miss the massive gains, or they hold too long and become an obvious target when silver goes parabolic. The smart play is diversification of storage and form. If you have 500 ounces, don't keep it all in one place. Don't keep it all in the same form. And definitely don't tell anyone the full extent of your holdings. Consider this strategy. Keep a small amount at home for immediate liquidity. Maybe 50 to 100 ounces in easily recognizable coins like American Silver Eagles or Canadian Maple Leafs. This is your emergency fund, your barter money if the system goes down, your insurance policy. But the bulk of your holdings, that needs to be stored more strategically. Private vaulting services that specialize in precious metals offer allocated storage where your specific bars or coins are segregated and insured. You maintain ownership. You can visit and inspect. But it's not in your house. It's not a target for home invasion, and it's not subject to the same reporting requirements as bank safety deposit boxes. Some holders split their storage between multiple locations. Some in the US, some offshore in jurisdictions with strong property rights and banking privacy. Singapore, Switzerland, and the Cayman Islands are popular choices for larger holders. But here's the critical part. You need to think about the form your silver takes. 500 ounces in 1 ounce coins is 500 individual pieces. That's bulky, that's obvious, that's hard to move quickly. But 500 ounces in 100 ounce bars is only 5 bars. Much more portable, much easier to store, but also much harder to use for small transactions. The ideal mix depends on your goals. If you're holding for wealth preservation and expect to sell when silver hits your target price, bars make sense. Lower premiums, easier storage, simpler to liquidate in large amounts. But if you're holding for potential barter or as insurance against system collapse, coins are better. More recognizable, more divisible, more liquid in a crisis scenario. Most sophisticated holders maintain a mix. Maybe 60% in bars for wealth preservation, 40% in coins for liquidity and flexibility. There's another consideration that's becoming increasingly important: the difference between numismatic coins and bullion. Bullion is valued purely for its metal content. A silver eagle is worth whatever silver is trading at plus a small premium. But numismatic coins, rare coins with collectible value, are treated differently for tax purposes and reporting requirements. Some holders are shifting portions of their stack into pre-1965 U.S. silver coins, often called junk silver. These are dimes, quarters, and half dollars that were 90% silver. They're recognizable, they're divisible, they're American currency, and they carry less of a target because they're not obviously precious metals to casual observers. A bag of pre-1965 quarters looks like old coins. It doesn't look like an investment. It doesn't scream wealth, but it contains roughly 715 ounces of silver. That's more than your 500-ounce threshold, but it's psychologically different. It's historically different, and it's treated differently in many regulatory frameworks. Now let's talk about the elephant in the room. What happens if they actually do implement confiscation or severe restrictions on precious metals? History shows us that compliance is never 100%. When FDR ordered gold confiscation in 1933, millions of ounces were never turned in. People hid it. They buried it. They moved it offshore. They held it in private vaults. And the government couldn't do anything about it because they couldn't prove who had what. The same would be true with silver, except for one critical difference: the digital trail. In 1933, most gold transactions were cash. There were no credit card records, no online purchase histories, no shipping manifests in searchable databases. Today, all of that exists, which means if they really wanted to enforce confiscation, they have the data to know who to target. But here's the thing: they probably won't go door to door. That's too expensive, too politically dangerous, too likely to cause violent resistance. Instead, they'll use the tax system. They'll use reporting requirements. They'll use the threat of penalties and prosecution to encourage voluntary compliance. And they'll focus their enforcement on the big holders, the ones with enough metal to make it worth their time. That's why 500 ounces is such a critical threshold. It's big enough to be worth enforcing against, but small enough that you're not a whale who can afford lawyers and offshore structures. You're in the sweet spot for enforcement. Big enough to matter, small enough to be vulnerable. So what's the real solution here? The answer isn't to sell your silver. The fundamentals are too strong. The upside is too significant. The monetary system is too unstable. Selling now would be like selling your fire insurance because you're worried the insurance company might raise rates. The answer is to become a harder target. That means diversifying your storage. That means being strategic about the form your silver takes. That means keeping your holdings private. That means not posting pictures of your stack on social media. That means not bragging at coin shows. That means not telling family members the full extent of your holdings. It also means having a plan for different scenarios. If silver goes to $100 and you want to take profits, how will you sell? Will you sell to a dealer and take the tax hit? Will you sell privately and risk IRS scrutiny? Will you trade it for other assets? Will you use it as collateral for loans? If the government implements new reporting requirements, will you comply? Will you move your metal offshore? Will you convert it to different forms that might be exempt? If economic conditions deteriorate and social unrest increases, how will you protect your physical holdings? Do you have adequate security? Do you have a plan to move it if necessary? Do you have trusted people who can help? These aren't comfortable questions, but they're necessary ones, because the target on your back is real, and it's growing with every dollar that silver climbs. Here's something else to consider. The timing of when you accumulated your silver matters. If you bought most of your 500 ounces when silver was $15 to $20, you're sitting on massive gains. That's a tax liability waiting to happen. When you eventually sell, you'll owe 28% capital gains on the profit. On a $20,000 gain, that's $5,600 to the IRS. But if you bought recently at higher prices, your cost basis is higher, your gains are smaller, and your tax liability is lower. That actually makes you less of a target for IRS enforcement because there's less revenue to collect. This is why some sophisticated holders practice tax loss harvesting with their precious metals. They sell portions at a loss to offset gains elsewhere, then buy back in after the wash sale period. It's complex. It requires careful record keeping, but it can significantly reduce your tax target. There's also the estate planning angle that nobody talks about. If you die with 500 ounces of silver and your heirs don't report it properly, they could face massive penalties. But if you've structured your holdings correctly, maybe through a trust or LLC, you can pass that wealth to the next generation with minimal tax consequences and maximum privacy. The key is planning now, while you have time, rather than scrambling later when enforcement increases or prices spike. Let me give you a real-world example of why this matters. In 2013, when gold and silver crashed from their 2011 highs, the IRS launched a major enforcement initiative targeting precious metals dealers and holders. They were looking for people who had made large gains and hadn't reported them. They were looking for dealers who hadn't filed proper forms. They were looking for structured transactions designed to avoid reporting. Thousands of people got audited. Millions in penalties were assessed. And the common thread was that these were people who thought they were flying under the radar but actually had left a clear paper trail. The same thing is going to happen when silver makes its next major move. Except this time, the IRS has better technology, more agents, and more political pressure to find revenue wherever they can. If you're sitting on 500 ounces that you bought at $20 and it goes to $100, you have $40,000 in gains. That's $11,200 in taxes owed. And if you don't report it when you sell, that's tax evasion. That's criminal. But here's what makes this even more complicated. The definition of a sale is broader than most people realize. If you trade your silver for gold, that's a taxable event. If you use silver to buy a car, that's a taxable event. If you give silver to your kids, that could be a taxable event depending on the amount. Every transaction that involves your silver potentially creates a tax liability. And with 500 ounces, you're going to have transactions. You're not going to hold it forever. You're going to sell some, trade some, use some. Each of those creates a potential audit trigger. This is why the really sophisticated holders work with tax professionals who specialize in precious metals. They structure their holdings to minimize tax liability. They time their sales strategically. They use like-kind exchanges when possible. They donate to charity for deductions. They use losses to offset gains. But most people with 500 ounces don't do any of that. They just stack and hope for the best. And that's exactly why they become targets when enforcement ramps up. Now let's talk about the international angle, because this is where things get really interesting. The U.S. government is increasingly focused on Americans who hold assets offshore. They've implemented FATCA, which requires foreign banks to report American account holders. They've increased penalties for unreported foreign accounts. They've made it much harder to hide wealth internationally. But precious metals are different. If you have 500 ounces of silver in a vault in Singapore and you've properly reported it, that's legal. That's protected. That's outside the immediate reach of U.S. enforcement. The key phrase there is properly reported. If you have unreported foreign precious metals holdings, you're committing a crime. But if you've filed the right forms, paid the right taxes, and followed the rules, you've created a layer of protection that domestic holdings don't have. Because if the U.S. government decides to implement capital controls or confiscation, they can't easily reach assets held in foreign vaults. They'd need cooperation from foreign governments. They'd need to go through international legal processes. They'd need to prove their case in foreign courts. That's a much higher bar than just showing up at your house with a warrant. But here's the catch. Moving precious metals internationally is complicated and expensive. You can't just mail 500 ounces of silver to Singapore. You need to use specialized shipping services. You need to deal with customs. You need to pay insurance. You need to set up foreign storage accounts. For most people with 500 ounces, that's not practical. The costs eat into your gains, the complexity creates risks, the reporting requirements create their own target. So what's the realistic solution for the average person sitting on 500 ounces of silver right now? First, accept that you're in a unique position. You have enough metal to matter, but not enough to afford the sophisticated structures that ultra-wealthy holders use. You're in the middle, which means you need middle-tier solutions. Second, prioritize privacy without breaking laws. Don't post about your holdings online. Don't tell people what you have. Don't make yourself an obvious target. But also, don't try to hide assets from the IRS or structure transactions to avoid reporting. That's how you go from being a target for theft to being a target for prosecution. Third, diversify your storage and form. Don't keep everything in one place. Don't keep everything in one form. Make yourself a harder target by spreading risk. Fourth, have a plan for different price scenarios. If silver hits $75, will you sell some? If it hits $100, will you sell more? If it hits $150, will you sell most? Having predetermined exit points prevents emotional decisions and helps you lock in gains before you become too obvious a target. Fifth, consider the tax implications of every transaction. Work with a professional if your holdings are significant enough. The money you spend on proper tax planning will save you multiples in avoided penalties and reduced liability. And sixth, stay informed about regulatory changes. The rules around precious metals are evolving. New reporting requirements are being proposed. New enforcement initiatives are being launched. You need to know what's coming so you can adapt before it becomes a problem. The reality is that owning 500 ounces of silver in today's environment is both an incredible opportunity and a significant responsibility. The opportunity is that you're positioned for potentially life-changing gains as silver enters what could be a historic bull market. The responsibility is that you need to protect those gains and protect yourself from becoming a target. Because make no mistake, as silver continues to climb, as economic conditions continue to deteriorate, as governments become more desperate for revenue, the target on your back will only grow larger. The question isn't whether you'll be a target. The question is whether you'll be a hard target or an easy one. The people who get caught are the ones who thought they were invisible but left obvious trails. The people who get robbed are the ones who talked too much and stored too carelessly. The people who get audited are the ones who didn't plan for taxes and didn't follow the rules. Don't be one of those people. You've done the hard part. You recognized the value of silver. You accumulated a significant position. You're ahead of 99% of people who are still completely dependent on the failing fiat system. Now do the smart part. Protect what you've built. Make yourself a harder target. Plan for success. And position yourself to actually enjoy the gains when silver does what we all know it's going to do. Because at the end of the day, the goal isn't just to own silver. The goal is to preserve wealth, protect your family, and maintain your freedom. And you can't do any of that if you become an easy target for theft, confiscation, or prosecution.